You've made the decision that now is the time to start getting serious about your finances in either your business or your personal life, and you've realized that you just don't know where to start. This can be extraordinarily frustrating, which is why in this video, we are going to be going over the basics of money management that's going to be able to be applied whether you're looking at it from a business or personal perspective. Even if you're a financial ninja, you should still watch this video so that you can leave your comments below to help others out who are just getting started on their journey. I'm James Masotti, and I'm the owner of Our Team Accounting. And on this channel, I am passionate about helping entrepreneurs achieve their personal and professional goals through intentional financial planning. Let's go ahead and dive right into today's video. All right, so now we're gonna go talking about all the different aspects about how to manage our money. And when we think about managing our money, the thing that we're probably gonna think about first is the fact that we have to actually have money to be able to manage. And that's why the first element of money management is going to be actually what you earn. You might be getting paid every month or twice a month or every 2 weeks, and this can change how much money you have. And when you're trying to do your budgeting and you have that magical month with 3 paychecks, if you're getting paid every 2 weeks, it can feel like you're winning the lottery. But you need to budget that money better, which is going to get us into our expenses. When we think about our expenses, what we're looking at is how it is that we're going about spending our money. And when we're spending our money, this is really going to get broken up into 2 pretty basic kind of categories. The first category that we're going to break it down into is essentials. These are the things that are covered by Maslow's hierarchy of needs, right? We're talking about food, shelter, water, and in the modern day and age, there's maybe a few other components that kind of factor into that. These are the things that we really truly mean are basic for us to be able to survive. In a business perspective, these might be things like paying our employees, because if we don't do that, they're probably not going to show up to work for very long. And then you've got things like paying your rent or your mortgage. You probably need to be paying your taxes if you don't want to go to jail. And these are some of the things that would fall under the category of essentials that you need to be spending your money on. After essentials, we have our discretionary spending. And discretionary spending is the difference between going to the grocery store and buying the basics and being able to buy more elaborate meals or being able to go out to eat. It may not always feel like it in today's day and age, but those are actually discretionary and luxury expenses. The same can be said if you're looking at your business. You have all the things that you most basically need from a software perspective, but then there's those upgrades that you might want to be considering, like, should I get additional staff or should I get a new piece of equipment? And you really have to ask yourself, what do you need those things for? Sometimes we just want to have things because they make us feel better, or they like to make our business look better or look cooler. There's a lot of things in vanity and in life that are driven by our ego. And we really got to ask ourselves, do we need that thing? A lot of the times the answer is not. So being really clear on what falls into what categories is important. Now, it doesn't mean that something, because it's discretionary, that it's bad. We need to enjoy life. We need to find enjoyment out of things. But there's probably a lot of things that you're spending your money on that you could live without. And that might improve your financial outlook and allow you to spend more time and more money doing the things that you do actually care about, which may also fall into the discretionary category. Once we've gone ahead and we've spent our money on these discretionary things, we're getting into the next level, which is going to be savings. Hopefully we've earned some money and we've managed to spend less money than we've earned. If you're not doing that, that's the first place that you really need to take a deep look at what you've got going on in your personal life or in your business, because you got to remedy that situation ASAP. As soon as you've done that, you start getting to the area where you can start saving your money. This is Benjamin Franklin's famous saying of a penny saved is a penny earned. And the reason for that is because money compounds. We are paid interest, and your money starts working for you when you start savings. As we get to the point where we've got those 3 months, 6 months, and some people it may end up being a year's worth of savings, we go to investing. And this is really where we start taking growth more seriously. Whether you go the more basic route of investing in the stock market, that's something that a lot of people are familiar with. And a lot of times you can do this in tax advantaged accounts through your retirement accounts. That's oftentimes the place that most people get their experience and their exposure to investing. If you're very fortunate to have an employer who has some sort of a match going into a 401k or an IRA, this is free money with the highest match possible, oftentimes at 100% of what you put in. So if you put in $1, you're going to immediately get $1 back before the interest even starts to compound on your money. Beyond that, we start looking at things like bonds and mutual funds, and these can oftentimes have interest rates that are a little bit better than what you would get in a savings account, but have longer term horizons on them and therefore allow you to compound your money over a longer period of time. Your money that sits in the stock market, if you let it sit there through market cycles, will on average get you somewhere between 8 and 10%. If you ever are at the point where you're starting to think about drawing down on your investments, this is when a concept known as your sequence of returns really starts to matter. But that is a far more advanced topic that we're going to get into. So when it comes to investing, you also need to understand that there's lots of different types of investments out there. The one that's most actively available to folks is the stock market, like we said, but you can also invest in a lot of other things. You could invest in precious metals like gold and silver and platinum. You can invest in things like art. You can invest in real estate is a very common thing for people to invest in. You can invest in businesses. So you can invest in the stock market. That's one way to invest in businesses, but you can also invest directly into businesses. You can invest in businesses with friends and family that you know who are either starting businesses or who are looking for additional capital to grow their businesses. And obviously, all of these different types of investment come with their own risk and reward profiles that you need to be familiar with, because where savings doesn't really have much of a risk because you probably have it in a bank that's insured by the FDIC, that means you can't really lose any of the money that you have in there. Whereas when you start investing, your money does have the potential to go to zero. So that's why we want to have our savings in place first. And then once we exceed our savings targets, start putting money into investments where we can grow our money at a far more aggressive rate. If you're looking for more support with your business financials, I want you to click the link in the description below where you can go find out more information about our DIY and our Done With You communities, as well as our Done For You solutions. Now that we've talked through investing, we get into this idea of being well-rounded and well-balanced. And so we also need to talk about spending our money. So we've talked about the expenses, but there's also just the idea of living more generically. And this is something that I personally really struggled with, was the idea that I was saving everything and not enjoying my life today. So when you get to this point where you start saving and you start investing your money, you really want to start to take a look at how much are you delaying your gratification. And there's a certain amount of delayed gratification that is a positive thing. However, one of the things that no human can ever get back is their time. And so as we get older and as we age, our health starts to fail us, our bodies may start to fail us, and it won't do us any good to have all of the money in the world and not have the time or the health in order to be able to take advantage of those things. So as we have gone up Maslow's hierarchy of needs from having our base essentials taken care of, we're making some money, we start being able to save our money, we start being able to invest it. This is the time when we really want to start reflecting on that self-actualization level of, what do I want to do with my life? Where do I want to enjoy things? And that becomes an important piece to really kind of consider as you go through this journey. One of the key reasons why this money management principle is really so important is for stability's sakes. So as we go and as we grow through these different stages of earning and understanding our expenses and getting into savings, there's going to be times in our lives and in our businesses where we're going to feel a cash crunch. And whether that happens every single month or whether that happens just periodically or hopefully even maybe never in some instances, you really want to make sure that you're ready for it though. That's the best thing to be able to do. And so that financial stability piece is one of the most critical reasons why solid money management is going to be important. Having good money management is also going to help you make better decisions. As you've gone through this journey, you're going to be learning more about money and you're going to be learning more about what options are available to you. So you're going to be growing from the lower levels of sophistication in terms of just having your money sit in savings accounts, maybe taking advantage of those 401ks, to starting to open your eyes to other investment opportunities. In the business world, this is going to go from learning to just keep your business running and keep the lights on and getting one foot in front of the other and starting to build traction, to having more serious conversations about how you're going to more aggressively grow your business through hiring other people or buying new equipment or things that are going to give you new capabilities to do more products and more services to service your clients. If you don't have a good foundation on your money management, then this is going to be really difficult to tackle those kinds of things. One of the other things that you can do when you have good money management is you can make sure that you have everything lined up with your goals. There's a lot of folks who just kind of go through their life spending their money, and there's a pretty good chance that if you've found your way to this video, you're wanting to have more intentionality with that. And often that comes through the purpose of goal setting. And so whether you're setting goals or business objectives, you have these things that you want to run everything as a funnel in terms of determining, is this the right thing for me to be spending my money on based on what I'm trying to accomplish? And I'll bring up an example that I hear a lot from business owners, which is the fact that they want to reduce their tax liability. But if you have the goal of buying a house, for example, you need to make sure that you're showing income and paying taxes on that income, or when you try to apply for a bank loan, you're not going to be able to qualify because you're not going to show any income. So this is an example of knowing what your goals are and being able to manage your money in a way that aligns with being able to successfully achieve those goals. And as long as we have those goals, the only way that we're really going to be able to march towards them is if we maintain profitability. Now, whether we're talking about profitability in the business sense or in our personal lives, what we're really talking about is at the end of every month, there should be more money left over than what we started with, meaning that we managed our expenses in such a way that we have leftover money. And as we compound that money, that profitability is what is going to allow us to grow. As you start thinking about managing your money, you're eventually going to run into the idea of what tools you're going to be able to have in order to help you manage your money and where it is all going. So the first tool that we're going to talk about are tools that you're going to be able to use that are going to help you track where your money's coming into and where it's going out of. These expense tracking tools is oftentimes what they are referred to, or budgeting tools or financial planning tools. And they're really going to be your starting block for where you're going to go ahead and look at where everything is going on. From the personal perspective, these are going to be tools like YNAB, which is You Need a Budget, which is a pretty popular one on the personal side of things. And on the business side of things, you're probably looking at a tool like QuickBooks or even Xero. Now that we've got our financial planning software under wraps, we want to start talking about our goal setting. And from a goal setting perspective, you really want to make sure that you are following the SMART framework. And by this, I don't mean just having goals that are intellectually stimulating, but rather ones that follow the acronym being specific, measurable, actionable, results-oriented, and time-bound. So when you're making your goals, you want to try to follow those. From a personal perspective, you can use tools like Streaks or Habitica to really make sure that you are hitting on those. Or from a business perspective, you could use a tool like 90.io or Workboard. Once you know what your goals are, then we really want to start getting into the automated savings and investing aspect of things. So if you're looking to do this from a personal perspective, you could be looking at tools like Acorn or Capital. And on the business side of things, finding a banking partner like Relay or Impressia are going to be great ways that you can kind of automate your savings every single month. Now that we've talked about these technology platforms, I want you to really think about the fact that this entire process is one of continuous learning. Whether you're starting from the process of just managing your expenses and then learning how to save and then eventually how to invest your money, you're constantly going to be learning about new things. And learning all of that new stuff is absolutely critical and totally normal for being able to go through this journey. Try and jump too far ahead and learn all the things that are possible, that might scare you off, but it also might motivate you. So you're never going to know until you just continuously learn about what kind of options that are out there. In order to make sure that you're successful in your learning and your continuing education journey, though, you're going to want to make sure that you're equipped with understanding some key terminology, which is why I want you to check out this next video over here to learn the 25 terms that I think everybody should know when they're going through their business finances. I'll see you over there.